you ever wondered where to invest your money but felt overwhelmed by all the financial jargon? Today, we're here to break down the basics of investing and help you understand the differences between stocks, ETFs, and bonds. Whether you're just starting out or looking to brush up on your knowledge, this video will guide you through the essentials. By the end, you'll have a clearer idea of how these investment options work and which might suit your financial goals best. Let's start this journey together and make investing less intimidating. Investing is all about putting your money to work so it can grow over time. Instead of letting your savings sit idle, investing allows you to potentially earn more by taking calculated risks. Different types of investments offer different levels of risk and return. Some might be safer but grow slowly, while others can grow quickly but come with higher risks. Understanding these basics is the first step to making informed decisions about your financial future. Let's explore what makes investing such a powerful tool for building wealth. You might ask, why should I invest at all? The answer is simple: to build wealth and achieve your financial goals. Investing can help you save for retirement, buy a home, or fund your children's education. By putting your money into assets that have the potential to grow, you give yourself a better chance at financial security. Of course, investing isn't without risks, but with the right knowledge, you can make choices that align with your needs and comfort level. Every investment comes with its own balance of risk and return. Generally, the higher the potential return, the greater the risk you take. For example, stocks can offer high returns but are more volatile, while bonds are more stable but tend to grow slowly. Understanding this relationship helps you choose investments that match your comfort with risk and your financial goals. It's all about finding the right balance for your unique situation. Start with stocks. When you buy a stock, you're purchasing a small piece of ownership in a company. This means you share in the company's successes and sometimes its failures. Stocks are known for their high growth potential, but they can also be quite volatile. Prices can rise and fall quickly, sometimes for reasons outside your control. Still, over the long term, stocks have historically provided strong returns for investors willing to accept the ups and downs. You invest in stocks, you're essentially betting on a company's future success. If the company grows and becomes more profitable, the value of your stock can increase. You might also receive dividends, which are payments companies make to shareholders from their profits. However, if the company struggles, your investment can lose value. That's why it's important to research companies before investing and to diversify your holdings to manage risk. One thing to remember about stocks is their volatility. Prices can swing dramatically in response to news, economic events, or changes within the company itself. This can be stressful for some investors, but it's also what creates opportunities for higher returns. If you're comfortable with these ups and downs and have a long-term perspective, stocks can be a powerful way to grow your wealth. Stocks offer several advantages. They have the potential for high returns, especially over long periods. They also give you a stake in the companies you believe in, and some even pay dividends, providing a source of income. However, it's important to remember that with greater reward comes greater risk. Stocks are best suited for investors who can handle short-term fluctuations and are focused on long-term growth. While stocks can be rewarding, they're not without downsides. The biggest challenge is their unpredictability. Prices can drop suddenly, sometimes for reasons that have nothing to do with the company itself. This volatility can be tough to stomach, especially if you need your money in the short term. That's why it's important to only invest money you won't need right away and to be prepared for ups and downs. Now let's talk about ETFs, or exchange-traded funds. ETFs are investment funds that hold a collection of different assets like stocks, bonds, or commodities. When you buy an ETF, you're buying a small piece of a larger basket of investments. This gives you instant diversification, which can help reduce risk compared to owning individual stocks. ETFs are traded on stock exchanges, making them easy to buy and sell. ETFs work by pooling money from many investors to buy a wide range of assets. This means your investment is spread out, so if one company or sector struggles, it won't have as big an impact on your overall returns. ETFs often track an index like the S&P 500, which represents a broad section of the market. This makes them a popular choice for investors looking for steady, balanced growth. ETFs offer several benefits. They provide diversification, which helps manage risk. They're also generally low cost, since many ETFs simply track an index rather than trying to beat the market. Plus, they're easy to buy and sell just like individual stocks. For many investors, ETFs are a convenient way to build a balanced portfolio without having to pick individual companies. While ETFs are a great tool for many investors, they do have some downsides. Some ETFs can be complex, tracking specific sectors or using leverage, which can increase risk. Also, while they offer diversification, they can still lose value if the overall market declines. It's important to understand what's inside an ETF before investing and to choose funds that align with your goals and risk tolerance. Now let's move on to bonds. Bonds are essentially loans that you give to governments or companies. In return, they promise to pay you back with interest over a set period. Bonds are considered safer than stocks because they provide regular income and are less likely to lose value quickly. However, their returns are usually lower than stocks or ETFs. When you buy a bond, you're lending money to an organization. In exchange, you receive interest payments, usually at regular intervals. At the end of the bond's term, you get your original investment back. Bonds are often used by investors who want steady income and lower risk. They can be a good way to balance out riskier investments like stocks. Bonds offer several advantages. They provide predictable income through regular interest payments, and they're generally less volatile than stocks. This makes them a popular choice for conservative investors or those nearing retirement. While the returns may not be as high as stocks, the stability bonds offer can be very appealing. Despite their stability, bonds have some downsides. Their returns are usually lower than stocks or ETFs, and they can lose value if interest rates rise. Also, if the issuer runs into financial trouble, there's a risk you might not get all your money back. It's important to understand these risks before investing in bonds. Let's compare these three investment options side by side. Stocks offer high risk and high potential returns, making them suitable for those who can handle volatility. ETFs provide a balance, offering diversification and moderate risk. Bonds are the safest of the three, providing steady income but lower returns. Each has its place in a well-rounded investment strategy. Understanding your own risk profile is key to choosing the right investments. Are you comfortable with big swings in value, or do you prefer steady, predictable returns? Stocks might be right for risk takers, while bonds suit those who want stability. ETFs can be a good middle ground, offering both growth and diversification. Knowing your risk tolerance helps you build a portfolio you can stick with. Your investment time horizon, how long you plan to invest, also plays a big role in your choices. If you have many years before you need your money, you can afford to take more risk with stocks or ETFs. If you'll need your money soon, safer options like bonds might be better. Matching your investments to your timeline helps you avoid unnecessary stress and reach your goals. Before investing, it's important to set clear financial goals. Are you saving for retirement, a house, or your child's education? Your goals will help determine the right mix of stocks, ETFs, and bonds for you. Having a plan makes it easier to stay focused and avoid emotional decisions when markets fluctuate. Diversification means spreading your investments across different assets to reduce risk. Instead of putting all your money in one stock or bond, you own a mix. This way, if one investment performs poorly, others can help balance things out. ETFs are a simple way to achieve diversification, but you can also build a diverse portfolio on your own. Many investors use a mix of stocks, ETFs, and bonds to balance risk and reward. This approach allows you to benefit from the growth potential of stocks, the stability of bonds, and the diversification of ETFs. The right mix depends on your goals, risk tolerance, and time horizon. Regularly reviewing and adjusting your portfolio helps keep you on track. Over time, your investments may grow at different rates, causing your portfolio to drift from your original plan. Rebalancing means adjusting your holdings to maintain your desired mix of stocks, ETFs, and bonds. This helps you manage risk and stay aligned with your goals, especially as markets change. Investing isn't free, there are costs to consider. Stocks and ETFs may have trading fees, while some funds charge management fees. Bonds can also have costs such as commissions or markups. It's important to understand these expenses, as they can eat into your returns over time. Choosing low-cost options can help you keep more of your money working for you. Taxes can impact your investment returns. Some investments, like stocks and ETFs, may generate capital gains or dividends that are taxable. Bonds may also produce taxable interest income. Understanding how your investments are taxed can help you plan more effectively and potentially reduce your tax bill. Liquidity refers to how easily you can buy or sell an investment. Stocks and ETFs are highly liquid, meaning you can trade them quickly on exchanges. Bonds can be less liquid, especially if they're not widely traded. Liquidity is important if you might need to access your money on short notice. Trying to time the market, buying and selling based on short-term predictions, can be risky. Even professional investors struggle to consistently predict market movements. Instead, focus on your long-term goals and stick to your investment plan regardless of short-term ups and downs. Compounding is when your investment earnings generate their own earnings over time. This snowball effect can help your money grow faster, especially if you reinvest your returns. The earlier you start investing, the more you can benefit from compounding, making time one of your greatest allies. Emotions can play a big role in investing. Fear and greed can lead to poor decisions, like selling during a downturn or chasing hot stocks. Staying disciplined and sticking to your plan helps you avoid costly mistakes. Remember, investing is a marathon, not a sprint. Building a portfolio means choosing a mix of investments that work together to help you reach your goals. This might include a combination of stocks, ETFs, and bonds. The right mix depends on your risk tolerance, time horizon, and financial objectives. Regularly reviewing your portfolio ensures it stays aligned with your needs. It's important to regularly review how your investments are performing. This helps you see if you're on track to meet your goals and whether any adjustments are needed. Keep in mind that short-term ups and downs are normal, so focus on long-term trends rather than daily changes. Many new investors make mistakes like chasing hot stocks, ignoring fees, or failing to diversify. Learning from these common pitfalls can help you become a more successful investor. Take your time, do your research, and remember that patience pays off in the long run. If you're unsure where to start, consider seeking advice from a financial professional. They can help you assess your goals, risk tolerance, and build a plan that fits your needs. While it's important to educate yourself, professional guidance can provide valuable support, especially for complex situations. The world of investing is always changing. Staying informed about market trends, economic news, and new investment products can help you make better decisions. Make it a habit to read, learn, and keep up with developments that could impact your investments. Successful investing is all about taking the long view. Markets will have ups and downs, but staying focused on your long-term goals helps you ride out the bumps. Remember, time in the market is more important than timing the market. Life changes, like a new job, marriage, or having children, can impact your financial goals and investment strategy. It's important to review your plan regularly and make adjustments as your circumstances evolve. Flexibility is key to staying on track. Before investing, make sure you have an emergency fund. This is money set aside for unexpected expenses like medical bills or car repairs. Having a safety net allows you to invest with confidence, knowing you're prepared for life's surprises. Automating your investments, setting up regular contributions, can help you stay consistent and take advantage of dollar-cost averaging. This strategy involves investing a fixed amount at regular intervals, which can reduce the impact of market volatility over time. To recap, stocks represent ownership in companies and offer high growth potential, but they come with higher risk and volatility. They're best for investors who can handle ups and downs and are focused on long-term growth. Stocks can be a key part of a diversified portfolio. ETFs are baskets of investments that provide instant diversification and balanced risk. They're easy to buy and sell and usually have low fees. ETFs are a great option for building a well-rounded portfolio without picking individual stocks. Bonds are loans to governments or companies that provide regular interest payments and lower risk. While their returns are usually lower than stocks or ETFs, they offer stability and predictable income, making them ideal for conservative investors or those nearing retirement. Choosing the right investment depends on your goals, risk tolerance, and time horizon. Many investors use a mix of stocks, ETFs, and bonds to balance growth and stability. Take time to assess your needs and build a plan that works for you. Investing doesn't have to be complicated. By understanding the basics of stocks, ETFs, and bonds, you can make more informed decisions and build a portfolio that supports your financial goals. Remember, the best investment strategy is one you can stick with for the long term. This video is for educational purposes only and does not constitute financial advice. Always do your own research or consult a financial professional before making investment decisions. Your financial situation is unique, so make sure your investment choices fit your personal needs.